Welcome to our 2023 webinar series. My computer froze. Sorry about that. Thank you for joining us. This year's theme continues to learn about insurance solutions that you and your clients can consider, plus the significant impact to insurers and their post-pandemic strategies. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. And today's webinar will be recorded and will be posted on our website within 24 hours in case you missed it. Today's presenter joined LLIS in 2008 and has over 20 years analyzing, studying, and researching annuity solutions. Here to present Cruise into Retirement with Annuities is Jerry Skapiak.
Thank you, Claudia. Welcome, everybody, and let's get started. So today we're going to talk about a few different types of annuities. We're going to look at fixed deferred annuities, immediate annuities. We're going to look at how we use annuities in our pension max calculations, deferred income annuities, and we're going to talk a little about income riders that a lot of your clients have on existing annuities when they come to you. All right, so let's start with fixed deferred annuities. So what are they? Well, you're basically going to earn a fixed interest rate for a set number of years. It could be anywhere from 2 years to 10 years, but they'll earn that interest rate, same interest rate for all those years. There are surrender charges on these annuities, and the surrender charge will typically match whatever the rate period is. So if we got a 2-year rate period, it'll have a 2-year surrender charge, 5-year rate period, 5-year surrender charge. And most annuities will have some type of penalty-free withdrawal you can take during those surrender charge periods. And that could be anywhere from the prior year's interest or interest earned to, I've seen them as low as 3% they could take out without a penalty, but typically it's 10%. Just depends on the annuity. And so with that surrender charge, why is there a surrender charge? Even the companies that offer like low load or products, they still have surrender charges on them. And the reason for that is, one, most agents are going to be paid a commission on the annuity, so that's one thing those surrender charges used for, to recoup that commission that's paid. But it's also to recoup their costs for underwriting. You're probably wondering, what is the underwriting on a fixed deferred annuity? There's no health underwriting, but they do financial underwriting on the annuities. So they basically just want to make sure the annuity is an appropriate investment for your clients. And normally those surrender charges are decreasing. Normally they decrease by 1% every year. So we've seen a nice uptick in rates. These are our most common rate periods, and this is where rates were back in July of 2022. And these are the current rates today. You can see the 3-year rates went up about 40 basis points, and the 5-year rate period still is the sweet spot for fixed deferred annuities right now. They're up about 90 basis points right now, so not too bad. A lot of clients are happy earning 5.2%, not dealing with the declines of the market or the turmoil of it. For those clients, could be a good investment for them. Immediate annuities. Well, because interest rates are up, we have seen a tremendous uptick in immediate annuities along with the fixed deferred annuities. So a common question I get asked with immediate annuities is, how much guaranteed income should we purchase? Well, I always say, if clients have a pension, if they have Social Security, compare that to what their fixed monthly costs are. And if the pension and Social Security is not able to cover the cost, then look at adding maybe an immediate annuity to give them the peace of mind so they know those costs are covered every month. So you want to look, factor in like the mortgage or rent, electricity, water, groceries, and don't forget about those insurance premiums. You want to make sure those are all covered. So I got a question here. What is the most appropriate type of annuity for a lifetime stream of income for clients' fixed expenses through their retirement? So that's going to depend. Typically, an immediate annuity will provide the highest guaranteed income. There are some equity index annuities, just because of where interest rates are, that can provide a very nice income stream also. It's kind of a case by case basis I typically have to look at for each client to see what's going to be the best option for them. So going back to immediate annuities, there's a few different types of payout options. We could do period certain payouts, or you could do payments over lifetime, which is what most people think of when they think of immediate annuities. But like a period certain payment, you could do those anywhere from, excuse me, a 5-year guaranteed period up to even like a 30 or 40-year guaranteed period. And so what that annuity does, it's going to pay for however long that period is. If the client passes away before they've received all the payments from the annuity, those payments will just continue to their beneficiary. Now, the most common type of payments that we typically see with immediate annuities is the lifetime payments. You can do a life only, that's going to produce the highest income. Depending if the client has no beneficiaries or anything they're worried about, then you can, they tend to like to look at those life only payments with no guarantee. But a lot of clients, they don't like the idea, of purchasing an immediate annuity. They pass away shortly thereafter, and the insurance company keeping all the money. So they'll start adding guarantees on it. So we got life and period certain. We'll use an example, life and 10-year period certain. That annuity is going to pay for as long as that client is alive. But with the 10-year period certain, what that does is if they die prematurely, there may be something for the beneficiary. So with the life and 10-year period certain, clients receiving payments, they pass away after 8 years. They didn't fulfill the 10-year period certain part of the annuity, so that an annuity will continue to make payments for the next 2 years to their beneficiary, fulfilling the 10-year period certain part. After that, the annuity stops and ends. Life with installment refund and life with cash refund, those are my two favorite payout options. What they do is they basically guarantee that the annuity is going to pay out at a minimum the premium that was paid into it. So, for example, a client puts $100,000 in, they pass away after receiving $60,000 of income. The installment refund option will continue to make payments to their beneficiary until it's paid out the full $100,000 out of the annuity, where the cash refund option will just turn around and write a check for the $40,000 to the beneficiary. Now, when you start adding guarantees onto the immediate annuity, your payment starts going down. So here we have Deborah, age 71, $200,000 check she wants to write for an immediate annuity. And this is where payments were back in July of 2022. We have seen an increase in interest rates, and here's where the payments are today. You can see when you look at the life only, we're at $1,378, and as you start adding guarantees on it, the payments start going down. The life and 10-year certain, the payment drops to $1,324, or if you go to the life and cash refund, the payment goes down to $1,275. For a lot of clients, they're okay receiving a little less income. They like knowing that that if they die prematurely, the insurance company is going to receive the insurance company is not going to keep all their money. That it will be paid out to their beneficiaries. I got another question here. How do you deal with the fact that inflation makes fixed expenses impossible to know? That is a great question. You kind of just look at where their expenses are today. If they have Social Security, that hopefully will continue to keep increasing, and if they need if their fixed expenses are growing too fast, you can always buy another immediate annuity later in life to help cover that gap again. We have a lot of clients that have purchased multiple immediate annuities over their retirement. So, Pension Max. This is your client. Hello? Sorry about that. I don't know what happened there. Pension Max, this is for when your clients have a pension and they're undecided on which option should they take. Should they take that single life payout from their pension, or should they take the joint and survivor payout to cover their spouse? So what Pension Max does, it kind of calculates to see what is the best way for them to go about doing it. So here we have Kyle and Jenny, both age 56. Now, if Kyle takes the life only payout from his pension, he's going to receive a larger payment from the pension, but if he predeceases Jenny, Jenny's going to be left with no income from that pension because that pension's going to stop paying when Kyle passes away. Or they could do the joint and survivor, receive a smaller amount, and that way, if Kyle does predecease Jenny, she will have some income coming in still. So with Pension Max, what we do is we look to see, can we purchase enough life insurance to provide Jenny with equal benefits if they took the joint and survivor payout from the pension. So the question is how do we do that? Well, we look at buying life insurance on Kyle to pay Jenny in the event Kyle dies prematurely, and Jenny could theoretically turn that lump sum into income. So the question is, how much life insurance does Kyle need, and how much is that going to cost? So the way we look at calculating that is we use a single premium immediate annuity to calculate the income for Jenny. So basically what we're doing is we're looking at how much life insurance does Kyle need to have that if when he passes away, can Jenny take that money and buy an immediate annuity to provide the same income as she would have received from the joint and survivor payoff from the pension? And the reason we use the immediate annuity is one, we're able to calculate those numbers. The immediate annuity is going to include mortality in its assumption. It uses multiple interest rates behind the scene in their calculations, and is guaranteed with conservative earnings assumptions. So what we're looking at is with Kyle, when he passes away, how much of that lump sum do we need to have for Jenny? But what happens with this, that the need's going to decrease over time. So Jenny, at age 55, may need income for 40 years, but as she ages, that amount of income is going to decrease, or that total amount she'll receive. So at age 85, she may only need income for another 10 years. So let's look at Kyle's pension. So if he takes his life only, he's going to receive $11,796 a year of income. If he does the joint and survivor, he's going to receive $10,071. So in a sense, the cost to them to ensure that Jenny's going to receive income if Kyle should pass away prematurely is $1,725. Now, the nice thing with life insurance is that's paid tax-free. So we look at a net after-tax amount of $1,467 or $17,595 a year. So that's the magic number. That's $17,595 a year. Can we guarantee enough income for Jenny with purchasing life insurance for less than $17,595 a year? So when today their biggest risk they have is if Kyle dies. He elects his life only pension and he dies. If that happens, Kyle or Jenny would need about almost $1.6 million to generate the income that's needed. Now, that need's going to drop over time. So in 15 years, they only need 1.25 million. In 20 years, 990,000, and in 25 plus years, $740,000. So with Kyle and Jenny here. So we're going to purchase life insurance on Kyle to replace income stream to Jenny for less than $17,595. That's our goal. And that's what we're trying to achieve here. So we're looking to see, can we use that life insurance to provide income to Jenny? So we're going to layer policies. Term insurance is the least expensive insurance there is. So in this case, the way it works out, it's a 15-year term for $340,000, 20-year term for $260,000, 25 for $250,000, and a no-lapse guaranteed UL for $740,000. And that is the most expensive part of doing a pension max, is guaranteeing that life insurance and that income for the years beyond what we can get with term insurance. And as you see, our total cost for doing this is $18,950. The pension cost is only $17,595. So in year one, our net extra income is $0. So a lot of people will look at this and think, okay, pension max really does not work in this situation. Well, but that's not the entire truth in this. Because with pension max and using the layer of the policies, we have built-in income in the policy. So as those term policies end, the premium they're paying for it is going to drop off. And it's going to give Kyle and Jenny more money in their pocket each time this happens. So for the first 15 years, there's no real savings at all for them. In fact, it's additional out-of-pocket cost. But when we look at years 16 to 20, now they're saving $378 a year. Still not that exciting. You jump to years 21 to 25, now we're saving almost $2,300 a year. And years 26 plus, we're saving about $5,571. So not bad. So that's when we're kind of really seeing the savings with it. But it's not just about the money with this. This comes with, it's a built-in pop-up option. So if Jenny predeceases Kyle, he can cancel all the life insurance and keep the full life-only payment from his pension, which is $11,796. If Jenny predeceases Kyle and they chose 100% joint and survivor payout, Kyle is still locked into that lower payment of $10,071 a year. So when does pension max work? Well, it works when Kyle's healthy. He's got to be a preferred or a preferred plus underwriting class for pension max to work. Has to be a non-smoker. Smoker rates are about 3 times as high as non-smoker rates. And he has to have time before he makes his election. Typically, we like to have 4 to 6 months. We got to make sure the policies get in place. We want to make sure he gets approved at that preferred or preferred plus underwriting class. If we go through underwriting and he's preferred at or approved at standard, this more than likely would not work. So he would be better off taking that joint and survivor. So we want to make sure that we can get the life insurance in place before he can make that pension selection. So when should they take the joint pension option? Well, right away, if the pensionee is a smoker, don't even look at it any other way, but just take the joint payout from the pension. If it's a government-sponsored plan, more than likely it's going to be the best option sticking with the government pension. If the pension has a guaranteed annual increase, so if it has a COLA feature on it, it's not going to work for pension max. The main reason for that is because we don't get that decrease in coverage over time, and you end up having to purchase a lot more of that guaranteed universal life policy, which is the most expensive part of Pension Max. So if you ever see a pension that has a COLA feature on it, they're going to be best off sticking with that. And if the client doesn't have time, if they come to you and they say, "Hey, I got to make my pension selection in a month," take the joint and survivor. That's really going to be their only option. It's not worth the risk of trying to get someone approved and them get approved worse than what was anticipated. All right. And if the pension is less than $2,000 per month, remember the bands. They typically don't work too well. We like to keep those life insurance amounts above $250,000 and above. That's where we're getting the price breaks for life insurance. All right. Deferred income annuity. These have become quite popular lately with the increase in interest rates. This is one of the most interest sensitive annuities that are out there. So, what is a deferred income annuity? Well, it's a cross between a deferred annuity and an immediate annuity. So, the reason I say that is with an immediate annuity, you have to start payments within the first 12 months of the annuity being issued. With a deferred income annuity, you have to defer that first payment at least 2 years until you can go all the way out to age 85 to defer that first payment. It's going to insure your clients against living too long. So if you do any stochastic modeling or Monte Carlo simulations for your clients, if you throw in a deferred income annuity, it will generally either increase the probability of success with the plan, or it may allow them to take out additional income early on in the life of the plan. Because you're going to have an income source kicking in later on in life. And it's usually used to supplement retirement solutions. So, what are the features of a deferred income annuity? Well, first, single premium only. It can be qualified or non-qualified money can go in it. We're guaranteeing future income streams, going to start 2 to 30 plus years in the future. Most common is deferring that first payment out to age 80 or 85. Payout options are similar to an immediate annuity. So you can get life only, life with any type of period certain, cash refund, installment refund. You can even set them up as joint contracts with all those other features also. There are no lump sum payments out of these annuities, so they are going to receive an income stream, whether it be monthly or annual from the annuity. Death benefits are available, and what I mean by death benefit is if the client should pass away before payments begin, their beneficiaries will receive back the original premium they paid. When these annuities were first initially designed, they offer death benefit, but the thought behind the original design of these was to have them without death benefit because they're really meant to insure against living too long. And if with life insurance, as you get older, the cost goes way up. So if we're not starting those first payments until age 80 or 85, it really does an impact on the income they're going to receive if they add on a death benefit to them. But they are available. And taxes, they are due to the owner only when they start receiving payments. So the money inside the annuity is going to grow tax deferred. Now, along with DIAs, the other popular product, very similar to a DIA, is a qualified longevity annuity contract, or a QLAC. What makes them different than a DIA? DIAs, if you're using qualified money, you have to start taking payments by age 72 because of RMDs. What a QLAC does is it's only for qualified money, but it allows you to defer the first payments out to age 80, 85. But what they do is the IRS limits how much you can put in a QLAC. So you can put up to 200,000 in them. You cannot put any Roth money in them. We still have the same deferral on payments, but our payment options are also limited. We can only do life only or life and cash refund. There's still no lump sum payments. You still have a choice of a death benefit we can put on, and taxes. And this is where a lot of people like using them, is the money you put into a QLAC is excluded from RMD calculations, which is going to reduce the taxes the client has. A lot of times these are used as a kind of a tax play, just to shelter some money from RMDs. All right, I got another question here. How are annuities priced, and how can an advisor tell how much an annuity costs in order to compare to other strategies to generate a steady stream of income? Just contact me. Let me know clients' ages, state they're in, and how much you're looking to invest, or how much income you're looking for, and then I can put something together for you. They're all with annuities. It's all based on state, whether it's qualified or non-qualified money, their ages, the payout option. All those affect the payouts. And in fact, we're going to look at payouts again here. So since deferred income annuity and QLACs are basically the same, the payouts are the same for them. So we're looking back at July 22nd or July 2022, and we have in the first column with a death benefit. So let's look at the single life. It's going to pay $3,451, but without a death benefit, they're going to get almost $1,000 or $1,100 more a year by not having that death benefit. And we're doing this for Jeffrey, who is age 65, putting $100,000 in and starting payments at age 85. So it costs a fair amount when you're adding a death benefit on these products. And then when we look at payments today, they are up, still going up, and with just interest rates in general, they kind of peaked in December of last year and have come down some this year. They've recently started going up a little bit again. But these products are extremely interest rate sensitive. Little changes makes very noticeable difference in the payouts. And then highlighted in the orange, these are the QLAC payout options that are available. All right. Income riders. So I've done this a couple of times where I've talked about income riders. They definitely relate to immediate annuities and income, and advisors seem to like this, so we've added it again into this presentation. So when you have a client that comes to you with, it could be a variable annuity. If it's a more recent sold annuities, it's more of an index annuity you'll see, but they'll have guaranteed income riders on them. They're extremely popular nowadays. So there are two main types of income riders on annuities. There's a guaranteed lifetime withdrawal benefit and a guaranteed minimum income benefit. So let's go over basics of income riders. Just to get an understanding of how they work, we're doing this on a very simple level here. So when you're looking at a statement for a client, they're going to have two numbers on there that are of importance. One's going to be the account value. That's the cash money. That's the real money. That is their money in the annuity. Then you're going to see another number on there. I'm going to call it benefit base. Companies use different terms for it. We're going to stick with the benefit base, but it's a number on the statement and nothing more. I call it the funny money. Clients like to think that that's their money, but it's not. The account value is their money. So let's say we have a client and they want to invest $100,000 into an annuity with an income rider, and this annuity is guaranteeing them 5%. It can be 5%, 6%, 7%, 10%. Um, doesn't matter. Typically, anything over 6% or up to 6% will be compounded. Anything 7% or higher is generally simple interest from what I've seen. But we're going to use 5%. We're going to compound it in our example. So a client has $100,000. They're going to put it in the annuity, and we're going to look. End of year one, their account value has grown to $103,000. So it grew by 3%. But we're told our annuity is going to grow by 5%. When clients come to you and tell you, like if they have a variable annuity or an index annuity, and they're said, well, I was told it's guaranteed to grow, what they're talking about is that funny money, that benefit base. And in our example, we're saying it's guaranteed to grow by 5%. So at the end of year one, our benefit base is worth $105,000, which is great. Year two comes along, annuity has great performance. It grows to $120,000. Our benefit base, guaranteed to grow by 5%, grows to $110,250. Guaranteed, just like we were told. But a nice feature of these riders on the annuities, they have what's called a step-up feature. And what that says is on a annuities policy anniversary, and that anniversary doesn't necessarily have to be annual. It could be monthly, it could be daily, it could be quarterly. Just depends on the annuity. In our example, we're going to use annual. It's the simplest way to look at it. So our annuity is going to look at the end of year two, and it's going to look and say, well, my benefit base is 110,000, but our account value is 120,000. So what we're going to do is we're not going to leave that benefit base at 110,000. We're going to step it up to $120,000. Year three comes, annuity loses money, but our benefit base is still guaranteed to grow by 5%. It grows to $126,000. Now we're going to stop playing with numbers and we're going to stick and kind of keep looking at year three. So we've got our account value is $80,000. Our benefit base is $126,000. Client says, this is great. I want to take my money and run. And they're like, give me my $126,000. Well, they don't get that. That number is only used for calculating income. That's why I call it the funny money. It's just a number on the statement that makes the annuity look great. And it can look great if they're going to use the annuity for income. So now we're going to go into our two types of riders now that we got the basics down. First, we're going to look at the guaranteed lifetime withdrawal benefit. Notice I say no annuitization. When you have a withdrawal benefit, you are taking withdrawals from the annuity. When you annuitize something, you are turning the money over to an insurance company and giving up control. When you have a withdrawal benefit, you're taking withdrawals and your account value is still sitting there where you can access it if you need to. So just remember, withdrawal benefit does not equal annuitization. So, and typically now when an annuity has an income rider that's a guaranteed lifetime withdrawal benefit, the annuity is going to say, depending on an age when they take their first withdrawal, is going to tell them what percent they can withdraw for life from that benefit base. In our example, we're going to use year our age 70, and we're going to withdraw 5.25%. So going back to our example, 80,000 account value, 126,000 benefit base. We're going to get 5.25% of the 126,000. So we get to withdraw $6,615. They can take that every year for as long as they like. But remember, you can't have both. If they touch that 80,000, take more than what they're allowed, more than $6,615, it's going to change how the annuity is going to work. It's going to change how much income they're going to have. So here I put together a simple chart. We're not focusing on growth or anything. Um, we're going to year 4 and we're going to start taking our withdrawal. So we're going to withdraw our $6,615, and that is going to be subtracted dollar for dollar from the account value. And I want you to look at year 16. We've been receiving our $6,615 and our account value hit 0. And you'll notice our benefit base hasn't changed. And if you look at year 20, we're still receiving our income. There's still no money in the annuity. So this annuity is purely providing income at this point. Now, for clients who have an annuity with an income rider, this is their goal: to live long enough with taking withdrawals under the income rider to deplete all of the money out of the annuity. Because it's only at this point the insurance company is on the hook. They've paid fees all these years for this annuity, and it's finally time for an insurance company to start going in their pocket and pay the client. If your client has a goal with the money in the annuity, they want to leave it to a beneficiary, then they are in the wrong product. Their sole goal should be to live long enough to take the money out and continue to receive income. So, with these annuities, I've said it's a withdrawal benefit. That account value is there. They can access that account value. So, what happens if the client withdraws more than their lifetime withdrawal amount is telling them? So, in our example, we got our 80,000 account value, 126,000 benefit base. So, let's say the client wants to withdraw $40,000 in that 4th year. They're not going to take their $6,000 that the income rider is going to allow. They want to take $40,000 out. They've been eyeing that new Mercedes AMG, and they want to put a down payment on it. So they withdraw that $40,000 out of the annuity. When you take more from the annuity than you're allowed, it affects everything. So in this case, we're going to withdraw 50% of our account value. So our account value is going to go down by 50%, but we're also going to reduce our benefit base by 50% now. So we're going back to our chart. Instead of taking out the $6,615, we're going to take out our $40,000. And you'll see our benefit base reduced to $63,000. So starting in year 5, we're not going to get the $6,615 anymore. That's going to be reduced down to $3,308. That's also cut in half. And then this continues on. If you look at year 20, we finally depleted our account value, but the annuity is going to continue to provide income. So the income rider still does just like it said it was going to do. It's going to provide the income for life, but it's just going to provide less because we took extra money out of the annuity. All right. The other popular rider is a guaranteed minimum income benefit. Client has 2 options with this rider. They can take withdrawals up to 5% of the benefit base for life, or they can annuitize it. And when you annuitize, you give up control and you have no access to the account value. So this rider gives you 2 options. So option number 1, we're going to start withdrawals at age 70 again. We have our example here: 80,000 of account value, 126,000 of benefit base, and we're going to get 5% of that, so it's going to give us $6,300 every year for as long as they live. Option 2, they can annuitize the annuity. Well, there's some other little factors with it. Typically, you have to wait 10 years before you can annuitize it. So it's not necessarily bad if they're okay waiting. It's also going to allow that benefit base to keep growing for those 10 years. Um, if they elect a step up is elected, a new 10-year waiting period starts. So you don't get that automatic increase like we were seeing before. They also do an age setback. And what does that mean? That means that, let's just say they're going to annuitize at age 70, they're actually going to use annuitization rates for a 60-year-old. And with with annuitization, the younger you are, the lower your payout's going to be. And they don't print this on the statement what your payment will be if you choose option 2. You have to call the insurance company for that. So with option 2, we have our numbers here, and we're going to annuitize that benefit base, and that's going to give them a little over $7,000 a year of income. So not bad. It just depends on what the client wants. So that's kind of all I had for today. We could definitely use a couple more questions, but we covered fixed deferred annuities. So that's where you get a guaranteed interest rate for a set period of time with the annuity. We looked at immediate annuities that provide income for life or possibly a period certain for clients. We looked at pension max. For your clients that have a pension and they're going to be retiring this year, it never hurts to have us take a look at it to see if maybe there's a better option for them. Deferred income annuities, that's where we're looking kind of like at. That's where we're kind of looking at income for longevity insurance for clients. You may have heard them referred to that. Um, right now, like I said, they're becoming more popular because interest rates have gone up on them. And then finally, we took a look at the income riders on annuities. So let's see. I have some questions are coming in. Please let them keep coming in. We need to fill a little bit more time up for this. If we want LLIS to review an annuity to help us understand it, what data do I need? The best thing to do is send me a current statement, in like an annual or quarterly. Don't send me like a confirmation statement, a transaction statement. Send me like a statement for the annuity. Typically, that's all I need. There is one or two annuities out there I may need to see the policy, but I don't want to have you go through the hassle of getting that. Just send me a statement first, and then I can generally get all the information I need off of that. I got a question here. What annuity do I own? I don't own any annuities. Personally, one, I'm too young, and when I retire, I would be considering an immediate annuity at that time. Not necessarily a big fan of uh, the annuities with income riders on them. Uh, just that's just my personal preference on it, but for a lot of people, it works for them. And I would also consider just a simple fixed deferred annuity. Interest rates are really good. I actually have placed my own father into one of them recently. Let me see what we got here. Can you please go over the difference between DIA and QLAC in regards to RMD calculations? Okay, when you put money, so for a deferred income annuity, if you're putting qualified money in it, you have to start payments by age 72 because that's when RMDs need to start. And if I'm wrong on the age by 1 year or so, excuse me, I'm not a tax professional, but the money you put in it will satisfy the RMD for that amount of money and only that money. So even if the annuity provides more income from it than what an RMD would have been if you didn't put in an annuity, you cannot use that extra amount to offset other RMD amounts. And in regards to QLAC with RMD, kind of the same thing. The money you put in it is excluded from RMD calculations. When does it make sense to use the index annuities with guaranteed income or withdrawal benefits? So, as I kind of said before, that there's some newer versions of these annuities coming out, and they are producing some very nice income numbers immediately for clients. And they're all guaranteed just like if they had an immediate annuity. So when does it make sense? It makes sense to look at them when your clients are going to need guaranteed income. So a lot of clients, they just like the idea of having guaranteed income. They don't like the idea of constantly tapping their savings every month to provide them with income. They like the idea of just having something deposited every month and not seeing their accounts going down because of those withdrawals. Do you typically see GLWBs where the benefit continues uninterrupted, unchanged for the spouse if the policyholder dies first, or how does that typically go? So if it is a spouse, you can have spousal continuation, which means it's nothing changes. The payments just continue for the spouse. For a non-spousal beneficiary, I have not seen where they will continue payments to a non-spouse. You generally fall into your requirements you have that the IRS has set up. So if it's a non-qualified annuity, they can either surrender it, they can do nothing for 5 years, or within those 5 years they have to take all the money out. They can annuitize it if it's within the first year of the date of death, or they can this is non-spousal for non-qualified. They could stretch it, meaning they can leave it sit in an annuity, and they have to take like an RMD type withdrawal out of the annuity every year. But basically, it's those payments they have to take out. IRS wants their money, basically. And if it's qualified, you all know the new rules around qualified money now. The annuities get no special treatment with that. Any other questions? Claudia, are we good on time? Just want to make sure.
We could use a couple more minutes.
All right.
Want to answer a few more?
Yeah, if we got some more questions, send them in.
Yeah.
All right. I see. I'm not scrolling down and seeing the questions. That's my fault. All right. Do you typically see GLWBs where the benefit? No, that's the one I just did. All right. If someone's concern is paying for long-term care and having some guaranteed income on top of Social Security to cover guaranteed expenses. So, like annuity we didn't cover is there are hybrid long-term care annuities where they're single premium, non-qualified only. You can put in, say you put in $100,000, you can get a long-term care pool of right around $250,000, and you can have it provide long-term care for you. There are some annuities with income riders that if the person goes into a nursing home, it will double the amount for a certain number of years. But you have to go into a nursing home. Most people want to receive care at home. They don't really benefit you in that aspect at all. All right. Where do MIGAs fall in this discussion? So when I was talking about fixed deferred annuities, those were MIGAs. And MIGA is a multi-year guaranteed annuity. That basically just means that the company will offer different guaranteed rate periods for that annuity. Um, our SPIAs pay out better when interest rates are higher. Well, that goes, yes, they are, and that kind of goes for any type of annuity where we're using interest rates for calculating them. And that's why we've seen such increase in annuities. Insurance companies have been inundated with annuity applications lately. Um, I want to say it was 2008 was the highest year for fixed deferred annuities. Um, Last year beat it, and it beat it by 18%. So insurance companies are playing catch up. They're starting to get caught up now. Okay. Uh, so using a period certain SPIA or DIA to fill early retirement income gaps and defer Social Security. Yes. Um, do that all the time. Someone retires at, say, 65. They want to delay taking Social Security to age 71, 72. You can definitely buy a fixed period certain annuity to cover that gap until Social Security starts. We do them all the time. Are annuities eligible for 1035 exchanges? Yes, they are. You can 1035 any annuity into another annuity. You can also 1035 exchange the cash value of a life insurance policy into an annuity. All right. Do QLACs really save taxes or just defer the taxes to later years? So the QLAC is saving taxes because, let's say they put 200,000 into it, that 200,000 is removed from their qualified account, so they're not having to take RMDs on it. But yes, they are deferring it to later years by doing that. What is the difference between full annuitization and electing lifetime income rider? Generally, how much more income with full annuitization? So that's really going. So with full annuitization, think of an immediate annuity. You're giving all the money to the insurance company, and they're giving you a guaranteed income stream. Where if you have an income rider, think of the guaranteed lifetime withdrawal benefit. You're going to be allowed to withdraw a certain percent for life. You theoretically have access to that account value. If the client ever needs additional income, they have access to it, but of course that will affect their guaranteed amount of income going forward will be reduced. So you're generally going to get more income when you annuitize. But there are some other options coming out now that it may be better to go with a guaranteed lifetime withdrawal benefit. It's just something that needs to be looked at. Can a client 1035 to MIGA? Yes, they can. The same, like I said before, you can use either another annuity or cash value of a life insurance policy can be 1035 to MIGA. And I think I hit all the questions. All right, here's one I missed. Regarding DIAs, are all of them for individuals, or are they offering DIAs or maybe a second to die type option? So with deferred income annuities, with QLACs, with immediate annuities, you can do all those as individual or joint. So that would be, yeah, you can do it that way. Sorry if I didn't cover that earlier. I think that's all the questions. Um, all right, here's another. Oh, we got a couple more here now. Um, what resources does a client have if they were sold an annuity that's inappropriate? I know there are free look periods, but after that, i.e., clients in early 30s and was sold a variable indexed annuity in a Roth IRA. Client doesn't have any particular risk aversion. Just got just got sold it. Um, Best thing to do is just wait out the surrender charges. Once the surrender charge is over, you can roll it back into a Roth IRA. It's going to be very difficult to go up against a broker or brokerage firm to try to get that reversed. Um, that's going to be your best option. So just pay attention to what the surrender charge period is on that annuity, and then once it's over, you can get out of it. Or they should have a 10% free amount they can take out each year. You could do a 1035 exchange out of that, or I guess a rollover out of it to a Roth IRA. What financial screening do you use to ensure that annuity providers will be able to keep paying during difficult economic times? So what I'm going to go over goes for all companies we recommend. So the first thing we look at is we look at their AM Best rating, and we only work with companies that have an A or higher AM Best rating. The second we look at is their Comdex score. And so what a Comdex score is, it's a percentile ranking, and it takes into account all of the financial ratings that companies receive from the various financial rating agencies and assigns a number to them, anywhere from 0 to 100. 0 being the worst, 100 being the best. And that number, it's a percentile ranking. So, for example, if a company has a Comdex score of 80, that means they're in the top 20% of insurance companies based on financial ratings. So, in the 80 number is our typical cutoff. With some of the annuities, we will go a little bit below that because they are guaranteed. Like MIGAs, for example, are not part of the general account of an insurance company. They're a separate asset on their balance sheet. So they're not subject to the creditors of the insurance company, just like in a variable annuity, how they're separate accounts. So we take that all into account before we recommend any companies. Do you think there is a case that it's not in the best interest? Not sure what they're referring to with that question. All right. Well, thank you, everybody, for attending today. Love the questions. Always like getting questions when I'm doing presentations. It makes it more exciting for me and also probably more exciting for you. That's all I have for today. Everybody have a good night, and we'll talk later. Bye.